Good morning. We are Group 6 and we are here to talk about financial reporting and management reporting systems. To start off, what is the General Ledger System? The General Ledger System is a hub connected to the other systems of the firm through information flows. Transaction cycles process individual events that are recorded in special journals and subsidiary accounts. Summaries of these transactions flow into the General Ledger System, and they become sources of input for the Management Reporting System and Financial Reporting System, which I will discuss later on. Information can also flow from the Financial Reporting System back into the General Ledger System as feedback. This is the relationship of the General Ledger System to other information subsystems. The light arrows are the business transactions that go into the General Ledger System, and then that overall information goes to the Financial Reporting System and Management Reporting System, as you can see with the dark arrows. The Journal Voucher. The Journal Voucher is the source of input to the General Ledger. It identifies the financial amounts and affected General Ledger accounts. So routine transactions, adjusting entries, and closing entries are all entered into the General Ledger via Journal Vouchers. The next slide will show you the format of a Journal Voucher. So this is a Journal Voucher record layout for a General Ledger master file. As you can see, it is what we commonly know as a journal entry. We now proceed to the General Ledger System database, which includes a variety of files. First, we have the General Ledger master file. It is the principal file in the General Ledger System database, and it is based on the organization's published chart of accounts. Second, we have the General Ledger History file, which provides historical financial data for comparative financial reports. Third, we have the Journal Voucher file, which is a total collection of the journal vouchers processed in the current period. Fourth, we have the Journal Voucher History file, which contains journal vouchers for the past periods. Both the current and historical journal voucher files are important links in the firm's audit trail. Lastly, we have the Responsibility Center file, which contains the revenues, expenditures, and other resource utilization data for each responsibility center in the organization. In connection to the last slide, this is the record layout for a General Ledger master file. We are now done with the General Ledger System, and we can now proceed to the Financial Reporting System. It is the management's responsibility to provide stewardship information to external parties. Much of that information provided takes the form of financial statements, tax returns, and documents required by the Securities and Exchange Commission. The primary recipients of financial statement information are external users, so stockholders, creditors, and government agencies. Generally speaking, outside users of information are interested in the performance of the organization as a whole. Given the nature of these needs, financial reporting information must be prepared and presented by all organizations in a manner that is generally accepted and understood by external users. These are the financial reporting procedures. Financial reporting is the final step in the overall accounting process that begins in the transaction cycles. The permanent balance sheet accounts are carried forward from the previous fiscal year. Then, the following steps occur. 1. Capture the transaction. Within each transaction cycle, transactions are recorded in the appropriate transaction file. 2. Record in special journal. Each transaction is entered into the journal. Recall that frequently occurring classes of transactions are captured in special journals. Those that occur infrequently are recorded in the general journal or directly on a journal voucher. 3. Post to subsidiary ledger. The details of each transaction are posted to the affected subsidiary accounts. 4. Post to general ledger. Periodically, journal vouchers, summarizing the entries made to the special journals and subsidiary ledgers, are prepared and posted to the general ledger accounts. 5. Prepare the unadjusted trial balance. At the end of the accounting period, the ending balance of each account in the general ledger is placed in a worksheet and evaluated in total for debit-credit equality. 6. Make adjusting entries. Adjusting entries are made to the worksheet to correct errors and to reflect unrecorded transactions during the period, such as depreciation. 7. Journalize and post adjusting entries. Journal vouchers for the adjusting entries are prepared and posted to the appropriate accounts in the general ledger. 8. Prepare the adjusted trial balance. From the adjusted balances, a trial balance is prepared that contains all the entries that should be reflected in the financial statements. 9. Prepare the financial statements. The balance sheet, income statement, and statement of cash flows are prepared using the adjusted trial balance. 10. Journalize and post the closing entries. Journal vouchers are prepared for entries that close out the temporary income statement accounts and transfer the income or loss to retained earnings. Finally, these entries are posted to the general ledger. 11. Prepare the post-closing trial balance. A trial balance worksheet containing only the balance sheet accounts may now be prepared to indicate the balances being carried forward to the next accounting period.
Re-engineering financial reporting. Online reporting of financial data has become a competitive necessity for publicly traded organizations. Currently, most organizations accomplish this by placing their financial statements and other financial reports on their respective websites as HTML, or the hypertext markup language documents. These documents can be then downloaded by users such as the SEC, financial analysts, and other interested parties. The HTML reports, however, cannot be conveniently processed through IT automation. Performing any analysis on the data contained in the reports requires them to manually enter into the user's information system. Thus, the solution to this problem is the Extensible Business Reporting Language, or the XBRL. But what is an XBRL? The XBRL is an XML-based language that was designed to provide the financial community with a standardized method for preparing, publishing, and automatically exchanging financial information, including financial statements of publicly held companies. An XBRL is a derivative of another internet standard called XML, or the Extensible Markup Language. The Extensible Markup Language. The XML is a meta language for describing markup languages. The term extensible means that any markup language can be created using XML. This includes the creation of markup languages capable of storing data in relational form in which tags or formatting commands are mapped to data values. Thus, XML can be used to model the data structure of an organization's internal database. So how do we distinguish HTML from XML documents? As we can see here in figure 8 to 6, we can see the differences between the two in a bookstore order formatted in both languages. Although essentially the same information is contained in both examples, and they look similar in structure, important differences exist between them. Although both examples use tags, words that are bracketed by the same symbols, and attributes such as though John, the way in which these tags and attributes are used differs. In the HTML example, the tags have predefined meaning. It describes how the attributes will be presented in a document. The book order in this example can only be viewed visually similar to facts and must be manually entered into the bookstore's order entry system for processing. Thus, end user computer cannot process HTML and can only be displayed the format. In the other case of the XML order, the tags are customized to the user, and the user's application can be read and interpret the tag data. Thus, the bookstore order prepared in application XML presents order attributes in a relational form that can be automatically imported into the bookstore's internal database. Thus, end-user computers can recognize XML and process accordingly, relieving some of the burden currently placed on web servers. The XBRL recognizes the potential benefits of XML. The ICPA or the AICPA encourage research into the creation of the accounting-specific markup language. XBRL is an XML-based language, as I mentioned earlier, that was designed to provide the financial community with a standardized method for preparing, publishing, and automatically exchanging financial information, and that includes the financial statements of publicly held companies. XBRL is typically used for reporting aggregated financial data, but can also be applied to the communicating of financial information pertaining to individual transactions. The first step in the process is to select an XBRL taxonomy. Taxonomies are classification schemes that are compliant with the XBRL specifications to accomplish a specific information exchange or reporting objectives such as filing with the SEC. In essence, the XBRL taxonomy specifies the data to be included in an exchange or report. The XBRL Standards Committee has created several taxonomies for widespread use. The next step is to cross-reference each account in the reporting organization's general ledger to an appropriate XBRL taxonomy element or the tag. To make the data useful to the outsiders and comparable with other firms, they need to be organized, they need to be labeled, and they need to be reported in a manner that all XBRL users generally accept. This involves mapping the organization's internal data to the XBRL taxonomy elements. The mapping process. The mapping process is accomplished using a simple tool such as a taxonomy mapper. Once the mapping process is complete, each database record will contain a stored tag as depicted by the taxonomy element field. Data mapping needs to be done only once, but the embedded tags are used whenever the data are placed in XBRL format for dissemination to the outsiders. This allows business entities to provide expanded financial information frequently and instantaneously to interested parties. Furthermore, companies that use native XBRL database technology internally as their primary information storage platform can further speed up the process of reporting. Users of financial data, for example the investors and the analysts, they can readily import XBRL documents into the internal database and analyst tools to greatly facilitate their decision-making process. From this new database structure, computer programs that recognize and interpret the tags associated with the data attributes can generate XBRL instance documents, or the actual financial reports. The XBRL instance document can now be published and made available to the users. The document can be placed on an internet server for internal use. It can be placed on private extranet for limited dissemination to the customers or trading partners, or it can be placed on the internet for public dissemination. In its current state, the instance document is the computer readable for analysis and processing. To make it more human readable, the HTML layout rules can be provided in separate style sheet that web browsers use to present the XBRL information in a visually appealing manner. Figure 8 to 7 presents an overview of the XBRL reporting process, or the key elements of which are discussed in the following sections. In here, we can see how it is divided into two. First, the one on the very top, which is the information reporting organization, and next, the information using organization. It begins with either the XBRL taxonomy and reporting organization's financial database, and then the taxonomy mapper proceeds to the reporting of the organization's financial database with embedded tax, to the XBRL instance document or the financial report, and the reporting the organization's website. It then proceeds down to the download of the financial report to the user system, and lastly, we proceed with the analysis of the financial information. The following figures are based on the XBRL taxonomy for financial reporting for commercial and industrial companies, referred to as the CI taxonomy. This illustration, as you can see, is based on an example prepared by Charles Hoffman, member of the XBRL Steering Committee Specification Working Group, with the assistance of Neil Hannon, XBRL Steering Committee Education Co-Chair. Figure 8 to 8 presents part of the hypothetical company's internal database. This snapshot shows the GL accounts and their values, as you can see in the presented figure. Currently, these data are organized and labeled according to the reporting company's internal needs and conventions. And again, to make the data useful to the outsiders and comparable with other firms, they need to be organized, labeled, reported in a manner that all XBRL users generally accept. Figure 8 to 9 shows the mapping process using the taxonomy mapper. Note how the XBRL tag labeled cash, cash equivalents, and short-term investments is mapped to the database account labeled cash in Bank Canada. Once the mapping process is complete, each database record will contain in a stored tag as depicted by the taxonomy element figure in the field of figure 8 to 10. Once the mapping process is complete, each database record will contain a stored tag as depicted by the taxonomy element field in figure 8.10. In here, we can see the database structure with the XBRL tag, as well as particulars on the full accounts, trial balance date, amount, account descriptions, and a taxonomy element. And lastly, figure 8 to 11 presents an example of an instance document. The XBRL instance document can now be published and made available to the users. The document can be placed on an internet server for internal use, and it can be placed in private external for a limited dissemination to customers or trading partners, or it can be placed on internet for public dissemination.
A brief history of XBRL reporting. In October 2005, U.S. banking regulators have required call reports to be filed in XBRL. In April 2005, the SEC began a voluntary financial reporting that allows registrants to supplement the required filings with exhibits using XBRL. In September 2006, the SEC announced its new electronic reporting system to receive XBRL filings. The new system is called IDEA, short for Interactive Data Electronic Application. In May 2008, the SEC issued rules requiring large publicly held companies to adopt XBRL by December 15 to meet financial reporting requirements. The current state of XBRL reporting. All members of the financial reporting community should be aware of XBRL as it is an important information exchange technology. In the near future, XBRL will likely be the primary vehicle for delivering business reports to investors and regulators. These developments are summarized below. Number 1. The quarterly call reports to be filed in XBRL impacted more than 8,000 banks. In December 2020, there were a number of new XBRL disclosure mandates in the Middle East, especially in Qatar, Oman, and Jordan. Number 3. The existing XBRL mandate was extended, including in Indonesia, where XBRL was extended to the notes of financial statements. Number 4. In the UK, which announced that it will adopt XBRL for statistical submissions. Number 5. In the US, where the SEC extended XBRL reporting requirements to closed-end investment companies. Number 6. In the Netherlands, XBRL has been used to great effect in real estate valuation reporting. Number 7. In both Denmark and the US, XBRL is benefiting financial reporting in the education sector. Number 8. In December 2020, there are 179 XBRL projects underway around the world. Consequent to these developments, in 2007, the Canadian Securities Administrators established a voluntary program to help the Canadian marketplace gain practical knowledge in preparing, filing, and using XBRL information. Regulators in China, Spain, Netherlands, and the United Kingdom are requiring certain companies to use XBRL. In addition, the use of XBRL will facilitate fulfillment of legal requirements stipulated in the Sarbanes-Oxley Act, which was passed in response to widespread concern and skepticism about financial reporting standards. In particular, XBRL can play a role in facilitating earlier reporting of financial statements required under SOX legislation.
Controlling the GL and FRS, or General Ledger and Financial Reporting Standards. Sarbanes-Oxley Act of 2002, or SARBOX, also known as SOX or SOX, is a U.S. law meant to protect investors from fraudulent accounting activities by corporations. SOX legislation requires that management design and implement controls over the financial reporting process. General ledger is a record of all past transactions of a company organized by accounts. Its accounts contain all debit and credit transactions. In other words, credit sales or purchase made by affecting them. On the other hand, financial reporting standards provide principles for preparing financial reports and determine the types and amounts of information that must be provided to users of financial statements, including investors and creditors, so that they may make informed decisions. There are 4 potential risks to the financial reporting system. First, a defective audit trail. Second, unauthorized access to the general ledger. Third, general ledger accounts that are out of balance with subsidiary accounts. Fourth, incorrect general ledger account balances because of unauthorized or incorrect journal vouchers. COSO, or the Committee of Sponsoring Organizations, control issues. Transaction authorization, segregation of duties, access controls, accounting records, independent verification, and its application controls. There are 2 independent verifications. Journal voucher listing is a listing that provides relevant details about each journal voucher received by the GLFRS. While General Ledger Change Report presents the effects of journal voucher transactions on the General Ledger account. Here is a format of journal voucher listing. It is a document on which is stored the essential information about an accounting transaction. This voucher contains a unique identifying number, the transaction date, transaction description, and transaction amount. Next is a format of General Ledger Change Report. This tool allows you to make balanced entries to many accounts in your General Ledger. It is the tool used to make adjustments and direct journal entries, entering opening balances when setting up a new system. Taxonomy mapping error. When you create XBRL encoded financial reports, you correlate each piece of information from the financial reports to a concept in the taxonomy. This process is called mapping. Validation of instance documents. Validation is a three-step process. First, you validate the taxonomy. Next, you generate the instance document, which creates an XML file associated with the instance document. XBRL is an XML-based framework and relies on XML syntax to declare semantic meanings such as XLink and XML schema. The last step is the creation of the instance document, which can be exchanged with other business entities or filed with a regulatory agency. The Management Reporting System is a part of a management control system that provides business information. This is often called discretionary reporting because it is not mandated, as is financial reporting. This information can be in the form of reports and/or statements. The system is designed to assist members of the management by providing timely, pertinent information. An MRS that directs management's attention to problems on a timely basis promotes effective management and thus supports the organization's business objectives. Factors that influence the MRS: management principles, formalization of tasks, organizational chart, responsibility, authority, span of control, principle of management by exception. This is an example of the organizational chart for a manufacturing firm. An organizational chart ideally provides the overall hierarchy and business order in a manufacturing firm. The key functionality includes production, purchasing, marketing, technical, accounting, HR, and customer service. Here's an illustration of the impact of span of control on organizational structure. A large span of control means a fewer layers of management within the organization and a relatively flatter organizational structure, which can lead to a faster decision-making due to fewer levels of approvals required for a specific decision, which allows the company to respond more quickly to business issues. A small span of control creates a steeper organizational structure which requires more managers and which will consequently be more expensive for the organization. To continue the factors that influence the MRS: management functions, level, and decision type. Includes implementation, strategic planning decisions, tactical planning decisions, and management control decisions. These are its management levels and decision types. The top level decisions have long-term implications, high risk, and uncertainty. Middle level decisions have 1 to 2 years medium-term implications, while the bottom level have routine decisions, no or very little uncertainty or risk. Strategic planning involves deciding and developing strategic plans to achieve strategic objectives or goals. Top management typically develops the strategic plans. These decisions or plans are normally long-term decisions, which are having implications for the next 5 years and above. A lot of risk and uncertainty is involved in long-term or strategic level planning. Strategic planning needs a thorough scanning and analysis of external environment to seek information. Tactical planning is done at middle management level, which mainly involves the resource acquisition and utilization to achieve the organizational goals. Tactical plans cover shorter time frames and are associated with less uncertainty and hence lower risk as compared to strategic planning. The operational planning decisions are taken at the bottom level of management, and these are routine decisions. These plans are prepared to establish account action. The operational planning decisions are taken at the bottom level of management, and these are routine decisions. These plans are prepared to establish actions necessary for achieving operational goals. These cover shorter time frame within a year. No or very less uncertainty in these plans and information needed is internal. They are stated in definite quantitative terms and can be spelled out in terms of time and targets. Here's a table of the classification of decision types by decision characters. The decision characteristic of strategic planning on its time frame is long-term. Its scope has high impact. Its level of details is highly summarized. Its recurrence is non-recurring, and its certainty is uncertain. In tactical planning, it is medium-term, had medium impact, is detailed, periodic, recurring, and highly certain. In management control, it also is medium-term, but has low impact, moderately summarized, periodic, recurring, and uncertain. While in operational control, it is short-term, has lowest impact, highly detailed, frequent recurring, and highly certain. To continue the factors that influence the MRS, in addition to management functions, levels, and decision types, it also includes operational control decisions and variance. Lastly is the problem structure, which includes structured problem and unstructured problem. This is the problem structure management level and information system usage. Based on the illustration, the top management level's information system uses a non-traditional information system, and its problem structure is unstructured. The middle management level uses both traditional and non-traditional information system and is partially structured, while the bottom management level uses traditional information system and it is structured. To continue the factors that influences the MRS, there are also types of management reports, namely management report and information content.
Program reporting. It provides information to solve problems that users have anticipated. Schedule reports are reports produced according to an establishment time frame. On-demand reports. Report attributes are the characteristic of a report to be effective. A report must possess the following attributes: relevance, summarization, exception, orientation, accuracy, completeness, timeliness, and concise. Examples of program reports: your projection for expense, sales, profit, growth, and etc. Responsibility accounting, the concept that every economic event affecting the organization is the responsibility and can be traced to an individual manager. Setting financial goals, the budget process that helps management achieve their financial objectives by establishing measurable goals for each organizational segment. Measuring and reporting performance. Responsibility reports are reports containing performance measures at each operational segment in the firm, which flow upward to senior levels of management. Responsibility centers are the organizational of business entitled into areas involving cost, profit, and investment. Here are the examples of upward and downward flow of information, as you can see. And here are also the bottom-up flow of performance information. And the third is the top-down flow of budget information. And the responsibility accounting. A cost center is an organizational unit with responsibility for cost management within budgetary limits. A profit center is an organizational unit with responsibility for both cost control and revenue generation. An investment center is an organizational unit that has the objective of maximizing the return on investment assets. Here are the examples of our cost center performance report, profit center performance report. Investment center performance reports are the distribution income statement.
The behavioral considerations. For this part, we have three considerations: the goal congruence, information overload, and the inappropriate performance measures. Goal congruence is the merging of goals within an organization. Lower level managers pursuing their own objectives contribute in a positive way to the objectives of their superiors. For example, by controlling costs, a production supervisor contributes to the division manager's goal of profitability. Thus, an individual manager serves their own best interests. They also serve the best interests of the organization. Information overload is the receiving of more information that can be assimilated. This happens when designers of the reporting system do not properly consider the manager's organizational level and span of control. For example, the consideration of information volume that would flow to the president if the reports were not properly summarized. Information overload causes managers to disregard of their formal information and rely on informal cues to help them make decisions. Thus, the formal information system is replaced by heuristics or the rules of thumbs, tips, hunches, and guesses. The resulting decisions run a high risk of being suboptimal and dysfunctional. And lastly, the inappropriate performance measures is when the behavior and performance measures are inconsistent with the objectives of the firm. Naturally, the organization wants this to happen through prudent cost management and increased profit margins. However, when ROI is used as a single criterion for measuring performance, the criterion itself becomes the focus of attention and object of manipulation. We illustrate this point with the multi-period investment center report in figure 8 to 24. Notice how the actual ROI went up in 2008 and exceeded the budgeted ROI in 2009. On the surface, this looks like a favorable performance. However, a closer analysis of the cost and revenue figures gives a different picture. Actual sales were below budgeted sales for 2009, but the shortfall in revenue was offset by reductions in discretionary operating expenditures or the employee training and plant maintenance. The ROI figure is further improved by reducing investments in inventory and plant equipment or the fixed assets to lower the asset base. Data analytics and ad hoc reporting. Data analytics represents a significant departure from the traditional structured reporting. First of all, we have the small data analytics. Characterizes techniques that employ data that are in a format and of a volume that allows them to be analyzed and acted upon by traditional technologies. Up next, the human resources, characterized and defined by the three VS: extreme volumes of data, the rapid velocity at which the data must be processed, and the wide variety of structured and unstructured data types that need to be integrated. First, we will tackle about the small data analytics. It is divided into several categories. First, we have the data warehouse. It is a database constructed for quick searching, retrieval, and ad hoc queries, and ease of use. Up next, the data mining. It is the process of selecting, exploring, and modeling large amounts of data to uncover relationships and global patterns that exist in large databases but are hidden among the vast amounts of facts. Next is the verification model. It is the drill down technique to either verify or reject a user's hypothesis. And lastly, we have the discovery model. It uses data mining to discover previously unknown but important information that is hidden within the data. Next, we have the big data analytics. This was introduced in the year of 1941. Its current rendition is characterized and defined by three Vs. First, we have the volume, associated with big data and refers to the terabytes, petabytes, and even exabytes of data. Up next, the velocity, the speed at which big data must be analyzed. And lastly, the variety. It is the primary driver of the volume. Big data analytics is divided into four big data reporting systems. First, we have the prescriptive analytics. It tells the user what action should be taken in response to the specific questions. And next, we have the predictive analytics. It encompasses a variety of statistical techniques that draw upon current and past data to calculate the statistical likelihood of future scenarios occurring. Next, the descriptive analytics. It is a mathematical process that describes real world events and the relationships between factors responsible for them. And lastly, we have the diagnostic analytics. It is a technique viewed past performance to determine why something happened the way it did. Aside from the big data analytics, stress and controls, we also have the data security. The data security is basically categorized into several categories as well, such as firewalls, access privileges, password control, system audit trails, and the outsourcing controls. So that would be all for the group F. Thank you so much for listening, and I hope that we have taught you something and you actually have learned something from us. Thank you, and God bless us all.